So let's just understand what are the different types of loan cost. Number one is definitely interest rate. We all know that. Now, all education loans use variable rates. Now we have always heard this, that few students or few applicants have this in mind, that there are few lenders who charge fixed rate, but that is not true. Every education loan is variable and uses variable rates. Now I'll explain this interest rate concept with a quick example here. It's a simple arithmetic example. So your interest rate for different lenders will comprise of a fixed margin plus a variable base rate, and combining both you will get your interest rate. Now your fixed margin remains fixed, right? Usually the lenders have a range for the fixed margin. It would be 5 to 10% or 8 to 11% depending upon different lenders, and this fixed margin stays the same your entire loan duration. It does not change, and it depends upon your credit worthiness. So which range will you fall into will be dependent upon how much credit worthiness do you have. Now coming to the variable base rate, this is the part that varies. Now it can change according to a set schedule, which could be every month or every quarter or every year. Now it's an important factor to note that whenever you're taking a loan, it is very important to ask the lender that what is the schedule or what is the pattern that they are following, whether it's monthly, quarterly or yearly. And based on that, you can do your calculations. Now, if the variable base rate changes, your total interest rate will also change. How? I'll just explain you. Now, as the base rate decreases, your interest rate will also decrease accordingly, and vice versa. Now, in this arithmetic example, you can see fixed margin is somewhere 6.5% for this particular applicant, and the variable base rate is taken as 2.41%. Now suppose in the next quarter, this variable base rate falls down to 2%. So the total interest rate will also change from 8.91% to 8.5%. Now there are few examples of variable base rate. In India, the banks or the NBFCs usually use the MCLR, that is marginal cost of lending rate. US uses something called the prime, and UK uses something called the LIBOR, which is London Interbank Offer Rate. It's a benchmark rate. And for Eurozone, they use Euribor. So these all are the examples of the variable base rate used. Now let us see that how interest rate affects you. Now each day that you have been disbursed money, that is called principal, the lender will charge you a nominal amount, which is called the interest. And they have the full right to use this money, right? So the moment you get your disbursement from the lender, the interest is charged from that date. Now two situations can happen here. You can either go for full principal or split disbursement. Now there are few lenders who will provide you the complete amount or the entire amount at one go, either to you directly or to your school directly. Now, while it may look that, okay, it's an easy process, I get the entire amount at one go, it is not that true. What happens is that you acquire a heavy interest rate even before you actually need the full amount. Now, what happens in case of Prodigy Finance? We usually disperse per semester as per the university needs. So we will disperse the amount as per the university's requirement, and we will disperse only that amount which is actually required by the applicant, not an excess amount, so that you are not burdened by excess interest rate. Now, second point is compound versus simple interest. Now, if I have to speak in a very simple term, compound interest means something, it is interest upon interest, right? That an interest is already accrued in the previous month. It is now for the current month, it is included in the principal amount, and a new interest is again added. So it builds up your interest component and it will cost you more. In case of Prodigy Finance, our loan product uses simple interest throughout the loan cycle. Now, do you think that interest rate alone will determine your true cost? It is not. Interest rate cannot or will not tell you the true cost of your loan. There are different fees associated with loans. Now let's just look what are the different fees. Now, there are some lenders who will make you pay those different kind of fees upfront, while there are others who make you pay the fee later on. So before speaking about the fee structure 1, I would hover around about fee structure 2 and explain those in details. Now, these are the smaller fees for different aspects of loan management. Number 1 could be the processing fee, that is the fee that the lender is charging to process your loan. Second could be your assessment fee. Third, the sanction fee or the sanction letter fee. Fourth one is a foreign currency exchange fee. Now, suppose you take a loan in a different currency than your country or school accepts, that is it could be US or Euro, etc. Suppose you take a different currency, you will incur some foreign currency charges as well. Then comes your insurance fee. So there are few lenders who also give insurance. So there definitely will be an insurance fee. So all these will be clubbed together as some fee structure. Now coming back to fee structure 1, this is basically Prodigy Finance's fee structure. We charge a single administrative fee, that is 2.5% of the loan principal amount. Now, how does the repayment happen, or how does the repayment affect a person? So nearly all the lenders will allow you to repay early without any fees. What is important is all these 5 questions that you need to ask before choosing which lender to go to and what are my repayment terms. So number 1 is, which currency do you plan to earn? So sometimes it happens that there are lenders who require to pay you back in the same currency in which you have taken loan, right? Suppose you are going to a US school and you get a job in Singapore, so you will be paying in Singapore dollar. So there are few lenders who do not encourage that, while there are few lenders who can also encourage that. So it is up to you how you decide to go with which lender and what are your terms and conditions. Then second one is, are interest payment obligatory during your studies? Few banks or financial institutions will require you to pay the interest component during your study period. Third question is, what is the maximum time you can get to repay the loan? So sometimes what happens in some unforeseeable situation where a person is not able to get a job, what happens to the repayment tenure? Is it restricted to the less tenure, or it can be extended as well? Fourth question to ask would be, how easy are the repayment channels? Do I have to do a bank transfer? Does someone have to go physically to the bank, speak to it, any other document needs to be signed, etc. And fifth, last but not the least, a very important factor, does it build credit history? So these are the 5 questions that a person needs to ask before actually thinking about when he or she thinks about repayment of the loan amount.